Guys, John Polemy here, Actionable Intelligence. Today is Saturday, May 24th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a registered financial advisor. I cannot give you individual investment advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, I guess the big news is the executive orders that President Trump signed this week with respect to uranium. It's definitely a big step forward, in my view. It sends a message to the market that your nuclear power is investable in the U.S. The regulations are going to become less cumbersome, and that we are going to streamline, we being the U.S., the NRC, Department of Energy, streamline the process to make it easier to build nuclear reactors, to make it easier to have a nuclear renaissance. So here's a few things from the fact sheet for the executive order. It says today, President Trump signed an executive order directing the reform of the NRC in order to reduce our dependence on foreign technologies, decrease regulatory barriers, and support our domestic nuclear industry. This order directs the NRC to complete rulemakings within 18 months to comprehensively revise its regulations and guidance documents with a focus on balancing safety concerns with the benefits of nuclear energy for our economy and national security. Basically, it's going to get down to the NRC has 18 months to approve a new construction and 12 months, I think, for a extension of life. President Trump is directing the NRC to reform its culture and realign its organization to reflect Congress's directive to rapidly promote nuclear power while ensuring reactor safety. President Trump is committed to reestablishing the United States as a global leader in nuclear energy, which will create tens of thousands of high-paying jobs and generate American-led prosperity and resilience. This is what I have been saying. Is it go as far as I want it to go? Not necessarily, but like I said, this is a big step forward, and I hope that it will continue in this vein and continue, this administration will continue to push. Goes on, there's some other blurbs here. Since 1978, only two new nuclear reactors have begun construction and entered into commercial operation. That's here in the U.S. Meanwhile, in just a single day, President Trump is signing twice as many executive orders to start a nuclear renaissance in the United States. The order establishes that U.S. policy will seek to facilitate increased deployment of new nuclear reactor technologies and expand American nuclear energy capacity from around 100 gigawatts today to 400 gigawatts by 2025. Well, that's the goal. We'll see if we can do that. We'll see what follow-up executive orders and support and congressional activity to support the industry and move it forward. We'll see what happens. Uranium stocks, I think, like the news, they bounced hard. Here's URNM, which is the Sprott Uranium Miners ETF. You can see huge volume. You can see the gap upwards. Here's various uranium stocks and how much they were up. You can see double digit across the board. Even Cameco was up like 10%. So there's this is, I don't know if this is going to continue. This could be, uranium stocks were depressed. They were out of favor for a long time. The spot price had been moving before this. It jumped about another $2 yesterday, I believe. So we'll see if this is the next move higher. This was the catalyst for the next move higher in uranium stocks. I have no way of knowing. It's impossible to know. Nevertheless, I think this was a good start for the nuclear renaissance that I was hoping for. And if it's followed up on, I think they should follow up on and continue to endorse this, continue to advertise this, continue to move forward with public-private partnerships things like this. We've talked about all this before. It's more positive news. Germany, you have the new chancellor there, Merz, former BlackRock guy, uh, drops its opposition to nuclear power in the EU. The EU had tried or was establishing nuclear power as a renewable source of energy for its climate change goals. Germany had been opposed to that during the previous government, and it looks like they're dropping that now. Obviously, France is the largest nuclear power country in Europe. So even they were moving against nuclear at some point, but they've changed their ways on that too. So many countries in Europe now are going pro-nuclear because you have to. If you're going to cut off cheap Russian gas, you have to come up with something else. And notice I pointed this out the other day to someone else. Notice you don't hear that much about renewables anymore. They're not dead. They're never going to go away, but you just don't hear that much. I do know that in the best bill ever that's going through Congress, I think it was passed by the House and it's going to the Senate. They're trying to gut the IRA of all the a lot of the renewable support and trying to redirect it to other areas, but we'll see if that goes through. I haven't done enough research on it, but I did see a headline. So going on, I kind of want to get into why I think, you know, I'm a little bit why I'm bullish about emerging markets and all these things. You know, here's the chart of US public debt as a share of GDP going back to like founding of the country. This is a tremendous chart, by the way. And you can see that during times of war, the Civil War, World War I, World War II, um, we had a spike in debt as a share of GDP because these were existential. Well, I don't necessarily think World War I and World War II were existential for the US, but let's leave that out. Nevertheless, there was a lot of government spending during these wars, but then you saw subsequent to that, uh, it dropped. And then it revved up during the Depression and then into World War II. And then they spent the next several decades whittling it down. Now we're at, close to 120% of GDP. And there was a lot of hope, and people were talking about Doge was going to find all these cuts. Well, they did find some cuts. And in the biggest, bestest bill ever that's going through Congress, they're not ratifying any of the cuts. Okay. So people don't understand there's certain things that the administration can do. They can give directives to the department heads, but it's the Congress that allocates the money. So if they're not going to ratify this, and even if they did, it's a drop in the bucket. And so the point being is that the government spending is not going to stop. We're still going to run very large deficits. Now, is that going to be a problem next week or next month or next year? I don't know. That's what they're going to continue to do. They're going to have a lot of tax cuts, hopefully, is what they're trying to push through. That's going to be negative for the deficit. Now, the idea is, well, we'll get these tax cuts and it'll stimulate the economy and we'll grow fast and then it'll make up the revenue. This is all the different machinations that they use. Basically, what needs to happen is massive government spending cuts, but that's never going to happen. And I've explained why that's not going to happen. But yet people persist in thinking it's going to happen. It's not going to happen. So whether we like it or not, the goal, one of the three arrows was to get of Bessonnet and this administration was to get the debt to GDP from 6% of GDP down to 3. I don't see that happening now. The whole agenda is off the track. I'm not ready to do a full assessment yet, maybe till 6 months in or 9 months in, but the whole agenda is off the tracks. It's just chaos. This thing cannot be fixed. Okay. Then you have a lot of people that are operating from their own self-interest. It's just typical politics, right? And, just because you say something on the campaign trail, the reality of politics of what's possible, this is what the average person doesn't understand. We have a system that's set up specifically to not allow for radical change. That takes a long time to do it, okay? Because how you can stymie things in Congress and how you can turn the Congress over every 2 years. and stop any kind of radicalization or these big swings in, who's there, the judicial branch, whether you agree with it or not, they are trying to insert themselves into these things. Whether they have the space to do it is beyond the scope of this discussion. But the long story short is, and the bottom line is, the people don't want things cut. It's that simple. Nobody wants to reform the entitlement programs. No one understands really what's going on for the most part. Quite a few people in the country, I would say a large majority of them are financially illiterate, can't manage their own finances, yet they're voting on who's going to manage the finances of the country. I mean, the whole thing is bizarre. And so this is positive until it's not positive. Why? Because if the federal spending is going to keep going up, that's going to be stimulative for the economy. That's, help keep us out of a recession during the Biden administration when they were running these huge wartime-like deficits. So if Trump's going to continue it, but via tax cuts, presumably it's going to be stimulative for the economy. And it's not just in the U.S. We're seeing Europe talking about €1 trillion spending, right, on infrastructure and defense. We're seeing rates coming down around the world, right? Central banks continue to cut rates. I'm tracking that. We're seeing China now finally has been stimulating. Okay. And so we have a lot of liquidity, a lot of stimulus coming into this market, right? And we're seeing a weaker dollar because of geopolitical situation. Okay. So what does that benefit? Well, as I've been saying, and what has been working, hard assets, emerging markets, things like this. And I think it's going to continue to work because I don't see anything changing over the next year, 2 or 3 years. It's a potential for, I don't want to use the word global boom, but, for the perception to change. Everybody's focused on these news headlines, tariffs, this, that, and the other. There's a whole world out there, and the world is actually, there is GDP growth. And then you're throwing all this stimulus on top of it. You know, what if the contrary play is there's going to be positive global growth? What does that do? So this is from the B of A Global Fund Manager Survey. Put up here lots of pessimism out there. This is the percent of the fund manager survey who see a stronger global economy in the next 12 months. And it's at like record lows. So people are very pessimistic. All the fund managers are on the what? One side of the canoe. It's just going to get worse, the global economy. But here's the World Economic Outlook, April 2025. This is from the IMF. Now you could say, well, it's the IMF. I mean, we're looking at growth, you know, possibly down a little bit this year, then reaccelerating next year. You see the United States is obviously, struggling, but then you have the Euro, Middle East and Central Asia, which I'm very positive on, Central Asia, by the way, emerging and developing Asia, Sub-Saharan Africa and Latin America and the Caribbean. So yet there's all this pessimism out there because people watch the headlines. Sentiment in the short term and liquidity is what drives things in the short term, typically. And sentiment's very negative because of all the trade stuff and all the other situation. Not to mention the fact, guys, that we have really super low energy prices right now. And so that's stimulative. And so what if we don't necessarily get a boom, but things aren't as pessimistic and end up being as bad as everybody thinks, and global GDP reaccelerates? Remember, interest rate cuts continue to happen around the world. I'm tracking that. And so that's continuing. If in fact the United States GDP slips at some point, the Federal Reserve is going to have to step in and start cutting rates, which is stimulative. This was also in the fund manager survey. Long gold is the most crowded trade, according to the fund managers survey. They asked them, what do you think is currently the most crowded trade? And gold for the second month in a row, is perceived to be the most crowded trade. What's the least crowded trade? Chinese tech. And if I come on here and say buy Chinese tech, no one will buy it. But look at the performance this year. Again, I don't necessarily in the AIA portfolio own Chinese tech, but I own plays that will benefit from the Chinese tech boom. Okay. And for the consumer class to turn around. As I said earlier, China's stimulating. And so we have ways of playing China, but not necessarily buying Chinese tech. Same thing. Look at how Europe is kind of under-owned. Now, I'm not suggesting you should be long Europe. It has fundamental structural issues. But again, in the short term, our European banks are doing very well that we have in the dividend portfolio. Why? Because of a set of unique circumstances. It's not necessarily based on, man, so things are so great in the EU. It's because these banks were forced to retrench. They didn't make a lot of loans. Their capital on their balance sheets far exceeds what they need to meet the regulatory requirements. And so they've been returning capital to shareholders. That's driving the price higher. That's even applies to Greek banks at this point. They got the right to do that recently also, like the last 6 months or year. And so if you're buying back shares, if you're increasing dividends, if you're still maintaining your capital requirements and everything's regulators are happy with what you're doing, that's what we want as shareholders. We don't necessarily need a lending boom. Now, I'm still bullish gold, but I think it's overbought. It made recent new highs again, I think, in the last week. So did Bitcoin. And of course, this is from the fund manager survey. No one owns energy. This is some of the most pessimism we've seen, pessimistic uh, weighting of energy since pandemic. And so I think you have to be long energy. It's ultimate contrarian play right now. No one, all the fund managers, there's no money in it. So I think there's an opportunity here, at least for a mean reversion. I think it's something like two standard deviations below the mean. So just reversion to the mean can equal a tremendous return. This is from Bison Interest, and it just shows the XOP, which is the oil and gas ETF, historical sell-offs during recessions and 3-year rebound. So it shows you the XOP sell-off in red during the 2008 recession, down 63%, the ETF, and then subsequent 3-year rebound up 128%. The pandemic was even more dramatic. You had a 50%, 7% uh, drawdown, and then a 288% return. This is in the XOP ETF. This is just the ETF, which is broad based, right? It's a got a fund with a lot of shares in it. And so, the last 12 months, the XOP is down 20%. Eventually, we get a turn. And if we're going to be entering a time when the globe is not necessarily going into a depression or recession, like some people think based on tariffs, you know, people say, well, we only have a 90-day deal on these tariffs. What happens when that runs out? They'll probably just extend it again. Okay. The midterms are every day that goes by, the midterm elections are getting closer. Politics rules the roost, guys. There's no people that are in there that are, including Mr. Trump and his uh, guys, that are necessarily, you know, ideologue. People want to stay in power. And so the three arrow policy really isn't working, in my opinion. Nevertheless, if the perception is wrong that we're going to have this big depression or worldwide recession, but yet growth is going to begin accelerating later as we move through 2025 into 2026, well, that's going to be an increase. That's going to require more energy. And so everybody is so offside on energy right now, it's screaming contrarian. So this is also from the fund manager. This is a anonymous chief investment officer out of New York. Quote, I think the market is way offside on the growth narrative next few months. We just had a huge China pivot and a big easing in financial conditions. Deficits are going to stay elevated everywhere as Doge underwhelms and Europe is forced to spend more. All growth positive. Focus will return to the tax bill, which I expect to be stimulative. So I can see growth reaccelerate after a tariff-induced hiccup, all while everyone is waiting for hard data to roll and the systemic community is re-risking. Every macro guy I talk to is bearish and hiding in front-end USTs, T-bills basically, waiting for that rollover. So the contrarian argument is we don't get the rollover. We don't have a deep recession. Maybe we have a growth slowdown in the US, but the rest of the world accelerates. So, what does that mean? Everybody's off sides. This is just one opinion. It doesn't necessarily mean it's going to happen, but this happens to be my view also. And again, gas prices are cheap. Memorial Day gasoline prices will be the cheapest since 2021. That was coming right out of the pandemic. Now, this has nothing to do with drill, baby, drill or what the administration has done. Energy's currently oversupplied. And perception is, that we're going to have a recession. And so oil prices have been down. They have strengthened recently. And I expect them to accelerate through 2025. Nevertheless, while they're cheap on an inflation adjusted basis, this is positive for economies. It's a tax cut. So, of course, the administration will take credit for it. I did see the press secretary. She obviously took credit for it and said, this is a result of the administration's policies. This is what all administrations do. But in the meantime, if you're watching what's going on, like in the Permian, amount of drilling rigs is going down, frac crews are going down. CEO after CEO says they're pulling back from capital spending, and so low prices are getting ready to cure low prices. This is why I think that at some point in the future, not too long from now, if growth reaccelerates around the world, combined with lower supply or a possible plateau of U.S. shale, we could be looking at very high oil prices over the next year to 18 months. Something else I didn't see a lot of people talking about, Bitcoin makes a new high. It's, well over $100,000 now. Not well over, but it's over 100,000. So it's recovered very nicely. Again, I'm not a all-in Bitcoin guy, but I see the rationale behind it. Again, part of my long-term narrative is even with this deficit spending and all this stuff's going on, at some point the chickens come home to roost. As I said to Steve Barton in an interview this week on In It to Win It, all roads lead to inflation inevitably. Okay, because the over-indebtedness is not going to be solved. There is no seriousness around us. Not a serious country. The West is not a bunch of serious people. They're in decline. They have all this debt. They have a bunch of problems that you're not going to fix in a 4-year presidential administration. The die is cast. So there will be periods of time during this decline when you do have counter trend rallies, but you are in a secular decline in the United States, in my view, and in the West. And I don't see, you know, that changing. And so increased deficit spending, increased debt, no one's doing anything about it. Eventually you get into a crisis and all roads lead to money printing. And so you have to be in hard assets for the long term. Okay. In my view. So this is Felix Zulauf, some comments that I saw from somebody else that interviewed him. He used to be on the Barron's Roundtable. He runs a shop out of Switzerland. He doesn't give a lot of interviews, but he's been very prescient over time. And I wanted to quote a couple quotes he had here, which I agree with and have been saying for a while myself. It says, politics are the primary market driver. Zulauf believes politics will play an increasing and disruptive role in financial markets in the coming years. Traditional analysis focusing solely on corporate earnings and interest rates are, quote, useless. Investors must understand political mood swings, quote unquote, and their impact on market sentiment and expectations. Absolutely. Absolutely. That's where we're at. We have so much government intervention. We have so much stuff going on with these tariffs. We have all these geopolitical things going on, and politics is what's going to drive things. Okay. And so ignoring them, like a lot of people not a lot of people, some people write in the comments, just stick to the market. This is the market. In the West, the governments and the politics is so intertwined with the markets. You have to understand what's going on. You have to see what the future leads to. Yeah. Ignoring that and just saying, well, I think the Fed's going to cut rates and so stocks will go up or something like this. Yes, these things will have a bearing, but the political environment does too. There, like I said, understanding that there is nobody in government willing or able even to cut spending or at least hold spending current tells you what's going to happen. Plenty of research has been done, and we have a historical record of countries that run deficits at the level we're running them at, and no one's ringing the alarm bell, eventually lead to economic problems, which result typically in the government trying to solve the problem with inflation. That's it. It's that simple. So I see nothing on the horizon of anybody wanting to change that. We've talked about it. So going on, what does he say? Another quote he had was, U.S. Treasuries are no longer a safe haven. There has been a notable change in fixed income and currency behavior. Zulauf said the U.S. Treasuries, for the first time, did not act as a safe haven during the recent market meltdown. They are now, quote, trading assets, not an investment asset, and certainly not a safe haven anymore. Again, we're going back to the late 70s, early 80s, when government securities in the U.S. were described flippantly as certificates of confiscation. As Russell Napier has talked about many times in his limited media appearances, we are moving to a more government-controlled, fiscal dominant situation where we're going to see financial repression, inflation, higher taxes, confiscation, things like that. It's just, the government doesn't have any money, guys. It has to get their resources somewhere. And there's no desire to cut spending. Maybe in Argentina, but not in the US or Western Europe. They're all talking about increasing spending. So this is my new country to pick on, Australia. The Labour government got in. So what do they want? They want, again, here we hear this again, tax on unrealized gains. So here is some blurbs about that. This is ridiculous. Every time this has been tried, and it has been tried other places, it results in wealth fleeing the country and creates economic problems. Okay. Doesn't allow for capital formation. Again, these people, you continue to rely on this permanent political career class, technocrats that think they're going to pull the levers and push the buttons and control society. They have no experience in the real world. They don't care. Okay. And so they're going to keep bringing out the old ideas and recycling them. Instead of just having the citizen farmer or tradesman or small business owner go there and serve a couple terms, 1 or 2 terms, and come back into private life, we have this professional political class that is specifically there for, itself, as I've said before. And so here is what Labor in Australia is planning on doing. Labor's tax on unrealized gains would only apply to 0.5% of superannuants, as it only applies to people with balances above 3 million. Leaving aside the moral repugnance of targeting someone merely because they are wealthy, the number of people impacted will expand. This is because the after-mentioned 3 million threshold is not indexed and Labor's budget is banking on bracket keep. The intention is to not raise the threshold so as to capture more people. That's right. So you have inflation over time, right? So you hold it at 3 million as more and more people go over the 3 million level, more of the unrealized gains situation applies to them. And so everybody should understand by now what this means. You know, basically in most places you get taxed on realized capital gains. And the reason why we have an incentive structure that if you risk wealth and time and these things and you get a payoff, you should be rewarded. And in the context of that, you're creating economic activity, jobs. This should be like elementary 101 stuff, but evidently it's not. Okay. And so we already know what's going to happen. because we have other situations. So the article goes on, and I'll put a link to this article in the show notes so you can read it yourself to understand. This is just pure stupidity. It's not going to work. It's going to lead to less capital formation, less economic activity, and wealth fleeing Australia. That's what's going to happen. So it goes on. The tax on unrealized gains can thus create a death spiral where only the assets left in the portfolio are unlisted, as all listed ones have been sold to pay tax. It is difficult to impossible to sell shares in unlisted companies. This begs the question of what happens then when there are no liquid assets left to sell. Well, what's going to happen is that the economy is going to be affected such that labor is going to be thrown out at some point, but there'll be a lot of tremendous economic damage created. Is exactly right. So if you are an entrepreneur and you create a company or a new technology and you have shares that you've sold to friends and family or raised capital, and it's not a listed share that's not being valued every day, and there's no exchange to sell it on, how do you, number one, arrive at a valuation? Number two, if you've sold all your other assets that are liquid, how do you liquidate your shares of your unlisted entity that you're trying to grow, okay, and pay your tax, your unrealized tax? And who determines that? Some bureaucrat wearing the pants from one suit and jacket from another one in the fourth sub-basement of some office in Sydney with a 40-watt light bulb and a green visor pouring over your financial statements? This is ridiculous. This is pure stupidity of the highest level. This is Goss plan Soviet type methodology, and it's not going to work. The good thing is we should keep an eye on Australia as investors and speculators. Right now, as this continues on, Australia is not investable. But as people sell assets off and they have an asset and prices decline, because that's what will happen, no one's going to buy the assets except at cheaper prices. We'll have a collapse in asset prices in Australia, and we'll be able to step in. And once this Labor government reverses this or it's thrown out, then it'll be a tremendous buying opportunity. You see how my mind works and how I think about it? So I wouldn't own Australian stocks right now. I wouldn't invest in Australia because this is stupidity of the highest level. This is anti-capitalist. And so after they get thrashed economically and asset prices collapse, hopefully the people there will wake up and throw them out, and then we could step in and buy the assets cheaply. That's how contrarianism works. Now, we know from Norway tried this. Here's a tweet. Norway raised its wealth tax to 1.1% and started taxing unrealized gains. The result? Over 100 of the top 400 taxpayers fled. 84 billion in wealth left the country. Tax hike lost 699 million in annual revenue. That's what will happen. Because I hate to tell you this, all you people out there that are envious of successful people or communists or socialists or whatever, or don't think that people should have more than people respond to incentives. And if you treat capital badly, it leaves. Get it? We've demonstrated this over and over and over. And yet you continue to have faith in this permanent political class of morons and sociopaths. And this is what you get. Oh, by the way, I forgot to tell you in the Australian narrative, guess who's exempt from this? Oh, that's right. The political class exempted themselves. You see how it works? Straight out of 1984. All animals are equal, except some animals are more equal than others. Get it? I don't know when the majority of the people on this planet are going to wake up and understand that the political class is not there for them. Okay, guys, that's it for this week. I thank you for tuning in. Hopefully, we're back on track with the videos. Hopefully, this will work. Appreciate this continued growth. I think I was up at one point to 15 in the top 15 on Substack Finance. So I appreciate that. Again, all of our offerings are on Substack, the free weekly email, AIA, paid service, which is doing very well. We're killing the S&P this year. So take a look at that if you're interested. And of course, see me on YouTube. We also have the Facebook Actionable Intelligence Alert. Facebook group where I put a lot of these charts and other things during the week. So you may be interested in that. Take a look in the show notes below. Thank you for watching, and we'll talk to you next week.